Good morning. Welcome to Stock Market Today. It's Friday, February 28th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today, brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email. Follow along with a lot of the content for this show, as well as get daily stock ideas for you to consider. It hits your inbox every trading day before the market opened. So U.S. equities were sharply lower in Thursday's trading as the sell-off continues. S&P 500 down by more than 4% yesterday and closed near the lows of the day. All sectors were lower as stocks entered correction territory. Treasuries were stronger with the curve steepening. The dollar was weaker on the euro and yen crosses. Gold finished little change. WTI crude down 3.4%. And as we get to the desk this morning, futures are down roughly 1%, but off the worst levels of the morning as stocks are on pace for their worst week since the financial crisis in 2008. Asian markets were lower overnight, led by China and Japan. European markets are under pressure as well. Treasuries are higher again with the curve steepening. The dollar is weaker versus both the yen and euro. WTI crude is off 4.3%, and gold is down 80 basis points to get us going on the final trading day of what has been an ugly week. Taking a look at the structure of the S&P 500, stocks enter correction territory. There's no two ways about it. Support now in the 2,900 to 2,950 area as that brings us back. We are back to within the consolidation that took place last summer. Remember, we had that consolidation and then the breakout, and we have swiftly uh, gotten rid of all of those gains to pull back into the consolidation level. Now, resistance is in the zone between 3050 and 3100. 3100 being kind of the top of yesterday's range, 3050 being this, the prior resistance during that summer consolidation. We are below the 200-day moving average, and the RSI is at oversold levels, getting down to about 20 yesterday. And with the sell-off and the way it works, Chaikin Money Flow has turned bearish. Chaikin Money Flow not only looks at volume, but looks at where a product closes within its range. And you can see throughout this week, the majority of the closes have been towards the lower end of the range, and that has pushed Chaikin Money Flow into bearish territory. So I would say that there's technical damage has been done. We could see a bounce in the near term, but now it's up to the up to the bulls rather, to prove the case. The bears appear to be in control here in the short term and for the time being. Let's look at our market in a minute now. What are we writing about in our note today? Well, equities fall into correction territory as coronavirus fears persist. We hit on that. Risk aversion certainly permeates the key relationships that we track. Remember, every Friday we look at key themes and relationships in the market to get a sense for risk appetite, and it's clearly pointing in the direction of risk aversion, though I do find it interesting that semis are holding near-term support on a relative basis. We're highlighting the key retracement levels for Qs today. Remember, we went through this exercise yesterday, and the S&P 500, and that index actually closed right at around the 38.2% retracement level. As we said, futures do point to a lower open here today. And we can see the damage that's been done from a power bar perspective here for the major indices. The Dow lost 4.5% yesterday. Now there are 0 bullish or very bullish stocks within that group for 10 bearish or very bearish stocks. The S&P 500 down 4.4%, 14 bulls to 132 bears, really getting down to the type of ratios that we saw in December 2018. NASDAQ, an underperformer on the day, down nearly 5%, 6 bulls to 20 bears there. Small caps were actually a relative bright spot yesterday, if you want to call down 3.5% a bright spot. It was down less than the overall market. 157 to 408 bulls to bears. Bonds uptick, sending yields lower. According to the Chaikin Power Bar, large cap stocks and small cap stocks have turned strongly bearish. Taking a look at our stock of the day, remember, auto-generated based on the power gauge rating, and it's office properties, and it's a REIT. REITs are an area of the market which tend to hold up better in times of uncertainty, and OPI, office properties, was down 2.5% yesterday when the major markets were down close to 4.5%. Chaikin Power Gauge rating for OPI is very bullish due to very attractive financial metrics, very strong price volume activity, as well as very positive expert activity. 20 factors, 5 in each of these 4 categories, give us our very bullish rating for a stock that's actually, we're not seeing a lot of this, but this stock is holding so far above the long-term trend line. Now, the industry group is weak. We look at the industry groups based on those power bars, and the power bars across the board have become bearish. What I'm seeing here is a stock that has a very bullish rating and is continuing to outperform the market as a flight to safety has led to relative outperformance on the part of groups like REITs and utilities. Now, money flow is bearish here as the stock has declined, but as I said, we're holding above the trend line, getting close to an oversold or actually just entering an oversold level. So I guess if you were looking to put money to work, if you felt like you needed to be invested in, you were looking for areas of the market that might be more resilient should this uncertainty continue to play out, office properties is the type of name you might want to consider, as REITs are likely to outperform, especially with rates heading lower. Take a look at OPI today, but again, I still think it makes sense to be really selective when adding new ideas. I think we want to be managing risk or continuing to manage risk for open ideas. And if you've been managing risk and your stop levels were hit earlier this week, that has been a good risk management tool as the decline has continued. Again, that's unique to you for your risk profile and your time frame, but I always think it's important to have some level of risk management as part of your process. Taking a look at the sector tracker now, moving to the major sectors over the last 5 days, and you could just see the carnage rate. I mean, the best group over the past 5 days is down 8.5%. Right, that is relative outperformance as the market is down more. And what you'll see is that the top 4 groups all have something in common. They're all defensive in nature: staples, utilities, healthcare, and REITs. Comms, industrials, discretionary, and fins are middle of the road. Materials, tech, and energy at the bottom of the list. And just look at the devastation within the energy space. Now, remember, we've been saying for some time that you want to continue to avoid the energy complex, and hopefully that has helped you resist the urge to go bottom fishing in an area of the market that just shows no signs of letting up to the downside. Tech is concerning. We want to see tech bounce back. It is the largest weight in the S&P 500, so always important to keep an eye on what's going on in the technology group. Financials have the added headwind of declining rates. So we continue to monitor sector rotation. It points to risk aversion, as do many of the themes that we write about in our note today. Now, our industry in focus is aerospace and defense, which has been an underperformer over the last 6 months, down by 7.42% relative to the S&P 500. And that power bar ratio is very weak: 9 bearish or very bearish stocks for only zero, I say only zero bullish or very bullish stocks, and it's currently ranked number 19 of 21 subsectors that we track, having moved down 14 slots over the past week. So the names there that you want to avoid or potentially look for opportunities on the bearish side: AeroVironment, AVAV, Huntington Ingalls, HII, and Northrop Grumman, NOC, all have very bearish Chaikin power gauge ratings. And if we look at XAR as a proxy for the group, what we'll see is the ratings turn neutral plus because we are below the trend line. This quick fall off, basically what this is designed to do is in precipitous declines, because the rating doesn't change as quickly, we move to a neutral plus on the technical selling that we're seeing. You can see the ratio here: 9-0 bears to bulls, weak trend below a now declining long-term trend line. Fund is oversold, but it's underperforming the market, so it doesn't really entice me all that much. I'd rather look, if you're looking at ETFs and different industry groups, I'd rather look at something like IGV, which I'm highlighting in my note today. Software is less bad, really. It's holding up. It's going down less than the market. In a decline like we're seeing, I certainly don't want to focus on the areas that are doing worse. Money flow sharply bearish. We are oversold. Maybe testing the bottom end of this summer support area close to the $100 mark, but just not enough there to get me excited just yet. Taking a look at what's trending now: yesterday's S&P 500 movers and shakers. PWR Quanta 6.31% to the upside. Some earnings follow through there. APA, their earnings announcement helps it buck the trend in the energy complex, up 2.6% yesterday. HBI, Haynes Brands, I didn't see any real news there to drive the outperformance in that stock, up 1.5% on a day when the S&P 500 was down nearly 4.5%. AO Smith, AOS, rebounding a bit after catching a downgrade on Wednesday. Still a bearish rating for that stock. And Borg Warner, BWA, up 1.26%. Nothing company specific that I saw to drive trading in that name. On the loser side of the board, Fleer down 17%. A lot of downgrades today following their disappointing earnings announcement yesterday. Perigo down 14.25% following their earnings report. Chipotle down hard on reports that Pershing Square, that's Bill Ackman's hedge fund, had reduced its stake in the company, down 10.8%. Holly Frontier is an energy stock. Did catch an upgrade today, but down 10% yesterday. And ANSYS, ANSS, down 9.64% yesterday following their earnings announcement. Still a lot of companies reporting earnings, right? It's easy to lose sight of that in light of everything else that's going on at the macro level and coronavirus. But still getting a fair amount of earnings reports trickling in as well. Let's look at the charts now, and the key charts that we're highlighting in our note today. Yesterday we looked at the key retracement levels for SPY. Today we're going to use that exercise on the Qs. Now the SPY tagged the 38.2% retracement level. Qs, as they've fallen out of bed, not quite there yet. 38.2% retracement at $201. 50% retracement at around 189, 190, and then 179, 178, the level that marks a 61.8% retracement of the move from the late 2018 lows to the highs that were achieved just last week, right? Last Wednesday, markets were making all-time highs, or at least the SPY and the Qs. So I just want to kind of highlight these retracement levels as areas to focus. Should we hit them and maybe start to stabilize or continue to slice through? Give you a sense of what's going on in the market within the context of what is now a prevailing short-term downtrend. I will note that the S&P 500 cut quickly below its 200-day moving average yesterday. 200-day moving average for Qs is at around a 198 level. So just something to keep in mind. It kind of falls right in here between these two key retracement points. So I just want to kind of highlight the key levels for you. We want to try to see if we can see any level of stabilization at those price points to maybe give us a sense that the intensity of the downtrend is weakening. So far, no signs of that, but we'll continue to watch trading here for the rest of the day today. Now, I said it before, I'll say it again. There were clear signs of risk aversion in the marketplace. And you can see that if you look at a ratio such as high yield debt relative to treasuries, right? We're using the ETFs for that. HYG, the high yield corporate bond ETF relative to IEF, the 7 to 10 year treasury bond ETF. And what we can see here is that after rallying throughout, starting last August, we have now faded, cut back below a declining 200-day moving average, and actually gone to new 2-year lows, taking out this support level. What's interesting to me is that during the rally, the ratio could not become overbought from an RSI perspective and is now hit oversold conditions. And this is, largely a function of a flight to safety in the marketplace. Investors are bidding up treasuries. You've seen what's gone on with the 10-year yield. We showed that chart yesterday with the 10-year yield moving to new lows below the 1.3% level. And high yield has come off now, right? We've had a nice uptrend in high yield along with equities since the lows in late 2018. We've now broken that uptrend line here over the past couple of days. So a flight to safety, risk aversion, call it whatever you want. It's clearly playing out in the marketplace across some of the key themes and relationships that we look at. We look at, we obviously look at this relationship. We see how small caps are underperforming. We can look at something like consumer discretionary stocks relative to consumer staple stocks, consumer discretionary, getting down near 52-week lows relative to the staples, right? Again, risk aversion in the marketplace, the key theme to take away over the past week. Now, if we are looking for a potential bright spot, it's the fact that semiconductors are actually holding the relative support zone that we've been highlighting. Taking a look at SMH relative to SPY, hasn't broken down yet. And that's something we're going to watch, right? We want to keep an eye on it. After this negative divergence at the highs, we're holding in this support zone, and the RSI is actually holding within bullish ranges. Now, semis have pulled back to test this uptrend line. If we can get some sort of stabilization in the relative performance of semiconductors as markets stabilize around those key retracement levels, we might have the building blocks to start to form a base. So this is something that we are going to continue to watch closely. And that's going to wrap us up for a Friday. I hope everybody takes advantage of the extra day we have this year over the weekend and maybe use it to sign up for our test drive, chaikinanalytics.com/test drive for a 14-day trial. I'll be back next week.